Hey, everybody, and welcome to the January edition 2026 of the View from the Ranch. I've got my festive partner with me, Chief Investment Officer Brad Tremitiere. Hello, Brad.
Hello, Greg. Happy New Year. I'm glad I'm in the spirit once again. You're just sitting there without the appropriate attire to ring in the new year, just like I did with Christmas.
Well, I think it's like a thing now,
I guess so.
for you. Like
Hopefully,
I didn't want to one up you.
hopefully people will turn in February. See what we're going to sport in February. Maybe I'll have a big Abe Lincoln hat.
Yes.
For President's Day or something like that.
That would look good on you, I'm sure.
We'll figure it out.
Yeah. So I like the glasses. Where did you get all this?
Here.
Amazon?
Maybe. I'm not going to list any names. Walmart. Just here to help bring in the new year and celebrate 2025 as we move into midterm election year.
Do you have any big goals that you're going to go for 2026?
Just to get up every day.
Yeah.
Be able to come here and share my thoughts and feelings on the market with all our fabulous employees at Ranch Capital.
And clients.
Clients too, but that's got to go through compliance most of the time.
Yes. We have to always dial it back a little bit of how we feel sometimes. But I think we give it straight. I think we give a good analysis of what's going on. And today we're going to do the same, where we're going to discuss 2025 and everything. Well, not everything, but some of the things that occurred that were important, and also looking back on what we can learn from it. And then we're also going to go over some of our points and thoughts about 2026 and what we're thinking and how we're going to be positioned going into it and what we're looking for. So you'll be able to see a lot clearer once you don't have those glasses on.
I'm fine. I'm going to wear them the whole time. Unlike last month's beard, I'm not going to do a wardrobe change.
Okay. I think your fans will be excited about that. So, well, good. Well, let's jump into 2025. We went into it. I think I was just reading. What did we say? I was looking at our January post, and we were staying long. We dialed it back, I'd say, a gear or two. If we have 5 gears, we kind of went down to third or fourth gear, neutral kind of going in. So I think the markets surprised a lot of us, maybe not you, but we weren't as confident, but we still stayed pretty bullish and pretty long the whole year. And that seemed to work out.
Most of our models, we remained long. We did raise, slightly higher amounts of treasury holdings versus some of the stock positions, but we're still probably 85-90% invested.
Yeah.
And the real reason to be a little bit more careful is concerns about a recession. But as we see, you can keep calling for a recession, but last 3 years it hasn't shown up yet. So,
which was interesting because there was a lot of red flags, and there's a lesson to learn from that just because it happened in the past doesn't always mean that it's going to happen
correct
in the future. And so it's a good lesson learned. There's a lot of times you'll see on Twitter or any newsletter that they'll have like one chart and said every time the chart does this, the market's going to crash, and then someone will likely try to sell you a newsletter out of that or get a following, but you got to just take it all with a grain of salt.
We try to lean on breath data as much as we can, and it was a little negative beginning of the year, and we had that big sell-off on Emancipation Day, but then breath let us out, and New York Stock Exchange breath made a new all-time high on Friday, 26th of December. So again, it's just very resilient. As we said before, it just remains resilient.
Yep. The market definitely holds true that it always tries to fool the most amount of people it can at any given time. And this year was no different. If you look back and the markets are up, we had 7 months in a row, could be, 8 months of gains. It's been kind of I'd say not too exciting market. It's been kind of a boring, but always take double-digit return gains.
Not to steal some thunder from our some of our 2026 discussion, but when you look at the American Association of Individual Investors survey that comes out every week, or the AAII, it's open to basically anybody to come in and say, what's your stance on the market, whether you're bearish, bullish, or neutral. And for the year, for 2025, now I don't know if we'll get another reading this week or not, but through the last post on Christmas Eve, it was a net like negative 10% for the bulls for the year. So the bears outnumbered the bulls by 10%. That's for the whole year. And when you
That's typically a good thing, though. Right?
Well, when you look at it historically, when that survey's that negative, the S&P is usually down double digits, but here we are today, and the S&P's up double digits. So it just goes to show you that psychology of people, of investors thinking that the sky is always falling.
Yeah.
The market's expensive. Blah 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 blah. Same stuff we hear all the time. Sure, it is. It will matter at some point, but 2025 it didn't, and you stay the course until there's a major change that tells you to get out.
I think that's just a psychological thing as well. It's just easier to talk about negative things, just in life and in the financial markets.
You look smarter. You go back to your comment about the people on Twitter. They're always on Twitter, saying this and saying that. Nobody has any idea who you are, but hey, you want to sound smart.
Yeah, it's usually not nice comments that they're doing.
And if you go back and look, use the Big Short as an example, those guys that were smart enough to figure that out, they didn't want anybody knowing. Usually if you've got an advantage, you don't tell people about it. So that's why you take a lot of information in this business with a grain of salt.
Yes, please do.
So yes, it was a good year. Third year in a row, it's been a strong year, which usually bodes well for the fourth year, but we'll get into that.
You did say that the first year of a presidential, or the first year, full year that a president's in the office, usually is one of the best years of a presidential cycle, and that held true this year.
We didn't know what to expect coming in because it's Trump as a second-term president, but not a consecutive term. So in a consecutive term, it's much more favorable, but he doesn't have the issue of quote unquote a new president.
Mm-hmm.
He came and got right to work. So maybe some of the issues that we'll talk about later on with the midterm year, maybe some of those issues have gone away because, he got working on tariffs right away, got taking care of taxes right away. Tariffs are an issue, which, the legality of some of the tariffs are an issue, which we'll discuss, but there's a lot that's been thrown at the market this year.
So tariffs were a big story for 2025. Back in April, the stock market had a pretty severe,
pretty nasty,
correction. A lot of panicking going on.
Of course, it happens while I was out of town at my dad's wedding. Go ahead, Go figure. Anytime I'm out, things fall apart.
Yeah. Well, you have a good reason to be out. And actually, the best thing to do at that point was to do nothing, right?
Well,
everybody who panicked and sold at the wrong time, and then you had this rip-roaring comeback that led to even greater highs.
Fantastic.
It was pretty remarkable to see. But everybody was a tariff expert at that point. Even my young daughter, who's not a big fan of Trump, was saying how all these tariffs are going to cause massive inflation. And I said, did you come to that conclusion on your own, or where did you hear that from? So a lot of the media and everybody's just saying this is going to cause inflation, and what happened to inflation this year?
It's gone down, and if it does anything, anything we realize with Trump is it usually causes volatility, but that initial bout of volatility is usually the worst that you're going to see. Mm-hmm. You buy that volatility in the case of Trump. Maybe it becomes different in the future, but for now, until it's different, that volatility kicks in, you buy it.
Yeah, and everybody has their narrative, so many of them get it wrong, though. It's just like the news media in general. Everybody thought tariffs were going to cause inflation. Didn't happen. Everybody thought the Fed wasn't going to be able to cut rates because of inflation. Well, they cut. But also, I think people thought they were going to cut even more. And so that, a lot of people were wrong on that as well.
Well, Fed's the Fed.
Yeah.
We've talked about it.
You love them.
Inflation, has been sticky in certain areas, but the major areas of inflation, such as the shelter portion, continues to fall. Now, there's somewhat of a delay there, but especially with what we're seeing in the number of house sellers that outnumber the buyers at this point in time, and where rents have gone, the major pressure on inflation, which, is housing and energy costs. I mean, look at gas. I mean, it's under 250 on average across the country, down, probably 25%, 25% year over year. I mean, that's a major benefit. We're not going to have inflation typically without wars and out of control oil prices. So,
and rents are down.
Yeah, some things might still be sticky, but they're not going to last for long. It's still going to take a while for everything that happened during COVID to balance itself out. But for the time being, this trend, although slower than what most would like to see, is going in the right direction with inflation.
I remember when I started in the business, we always used 3% inflation.
Okay, I'm
rates.
taking them off.
Thank
I'm
you.
taking them off.
There he is.
Okay.
Everything was 3% modeled. Now it's got to be 2. It's like, is that realistic?
No.
I don't know.
It's an arbitrary number that the Fed came up with that makes 0 sense.
Okay.
Inflation should be 0. They should not have any inflation at all, but they seem to think 2% is healthy. I would say 0% is healthy.
Okay. Yep. Just not 8 or 9%.
Yeah.
That's gonna. And what else happened in 2025? So tech again was the big winner, and I think a lot of people who invest in like passively in the S&P 500 and indexes don't quite understand how concentrated this market has been. I mean, it's really been those top 7, the Mag 7 names that have driven this market. And it'll be interesting to see if the other 493 stocks start doing better next year because of how concentrated that is. But it certainly was, tech, semiconductors all led in 2025. Got whipsawed a little bit between small caps, utilities. Consumer staples seem to be hurting the most, I guess, out of ever since COVID, when they can't raise their prices anymore and shrink their product anymore, and so they've had a difficult year. But and then the foreign markets, like, give it up for foreign markets, the first time outperforming the U.S. in quite a long time. So,
well, to go back to tech and AI, I mean, we talked about it last month. I mean, everybody now suddenly is an expert on, data center and artificial intelligence.
Yeah.
CapEx.
How much they're investing.
Yeah, it's ludicrous to get upset at these companies for the amount that they're spending, because without them, we probably would have had a recession. Without this spending that's taking place with these larger tech companies and build out of data centers and the whole infrastructure surrounding, data collecting information, Internet of Things, AI, there really isn't much in the way of spending that has taken place that would be supportive of the markets and the economy. So sure, they deserve a breather. Do I think things will change going forward? No. I think the trade's expanded out, that it's not just NVIDIA, or it's not just Microsoft, or it's not just Amazon. It's now other companies that are getting involved. Sure, there's some ancillary names that, aren't worthwhile investments because they...
Through pets.ai?
Yeah. Pets.ai. But as far as the market being narrowed, I mean, we're used to it. This leadership has always remained the same. It took a breather for a while in 2022, but it came roaring back. Until that changes, I hope it would expand. The market would expand out as far as participation, but these cycles happen. They just cycle through. Most of these companies have a day in the sun, but they don't last very long.
You think that investors should be looking at more of like an equal weight this year?
Well, I think there's some...
Maybe do a little bit of both. Because if you got S&P, you got 50% of your money in...
Yeah, I mean, that's the issue, is you can't
stocks,
get away from these stocks. You can buy all your mutual funds. They're all going to own the same stocks anyway. So you can look at more of a equal weighted index if you wanted to. But again, when you look back on weighted versus equal weighted, most of the gains has come from the higher weighting. So
I think equal weight was up like 10% this year versus
until
the
that
S&P.
changes, there's really nothing to do about it. At some point in time, there'll be problems. I just don't see it happening.
So keep riding that
just
train.
yet.
Okay.
And international, we've had some exposure. I wish we'd go back a year and have more exposure, but again, that's a trade that has not worked out for 2 decades.
Yeah.
So it's nice to see participation, but you got to realize a lot of these foreign indexes are just getting back to where they were a couple of years ago, and we're much further along now. Is it a valuation thing that makes them more interesting? I don't think
They've
so.
had low PE
Yeah.
ratios forever.
It's just, investors' money moving other places.
Mm-hmm.
So that trend may continue this year. I just don't think it's going to be as prevalent as it was in 2025.
Now, did the dollar fall from, where's that at from a year-to-date basis? Is it
It's down
is
about
it-
9%,
Okay.
I think.
I mean,
or
that
so.
helps in international trade, though, too, right?
Yeah.
Just that currency exchange. So if it falls 9%, you're, pretty much getting.
You're
that
stealing
equal.
one of my thoughts for next year.
Ah, see, next level thinking. I know what you're thinking already. So we've been partners long enough.
Yeah. Business partners.
Business partners. The quiet story. All right. So let's talk about the consumer, because this was one of the things that we watch, jobs reports, which has been like, you can't even trust a lot of the job data numbers. It feels like they're always revising, but the strength of the economy is always going to be on spending. And it seems like I learned this new thing called the K-shaped economy, where you have the K-shape, that the people who have more are doing better. Their stocks are up. They're spending on luxury, but the middle income, lower income are struggling and not benefiting from that. And so you're also seeing more layoffs. You're seeing the housing market struggle still. Even though inflation has come down, it didn't mean prices really came down a whole lot. It's just that they quit growing as fast. And so you have this whole segment of the economy that's not doing so well and are starting to struggle. And we thought, they would maybe start struggling a little bit more this year, but people seem to be finding ways to spend or borrow. Consumer credit is up, delinquency is slightly up, but the unemployment numbers are starting to creep up. Except, really what's helped it was healthcare jobs and was it leisure or social services. So not a lot of jobs that were like in manufacturing or technology jobs that are driving the economy. And so that's, to me, the biggest. Those are, to me, the two biggest things: is the jobs, is how is that going to continue to hold up, and then, well, the real estate market, if interest rates, mortgage rates continue to remain high, even though the Fed cut, you got a slight break in mortgage rates, but housing is so unaffordable right now.
I think real estate's fighting a two-front war. You don't have enough houses for people to get into that are quote unquote affordable. So there's a shortage of housing. On the other hand, you still have high mortgage rates relative to what we've had the last 15 years. So the idea of cutting rates and doing some other things that we'll get into about of the Fed and Treasury is to bring down those borrowing costs so that people can get into the housing market. And that would, if we can get mortgage rates down, that's another boost for the economy. But
that's the only thing, in my view, that will save the housing market.
We need more housing, more affordable housing, not
Can they
starter
build,
homes,
can
more
they build,
more starter
can they
homes.
build that though?
Yeah, I'm sure they can. It's just a complex issue that will get worked out.
I've read somewhere that the average first-time home buyers in their 40s.
Yeah,
used to be in their late 20s or early 30s. So that's concerning.
On the other side, though, looking at jobs, I think the job market looks great. Because of all the jobs that have been lost are mainly on the government side, and those, the bloating of government payrolls in 23 and 24. At 1,000 times a month more than what the average had been historically, can't go on. It's just a massive albatross for the economy, because you're overemploying people with better benefits than what you get in the private market, and they offer no tax benefit to society. So I'm sure there's probably some government jobs that have been lost that we do need, but there's no way that you're going to hire 45,000 government workers on, a federal, state, and local level each month for 2 years versus like 450 on average between, 2010 and 2019. It just makes no sense. So, and also there is most of the new jobs, most of the new hires this year, all of them have been natural citizens, not people that are in the country as, I don't know if you call them illegal aliens, if you call them refugees, if you call them asylum seekers. If you look at the data, we'll call them foreign-born workers. Most of the jobs the last 3-4 years have all gone to foreign-born workers. So
childcare too, right?
This year, we're not going there. This year, all the jobs went to native. I would say, you can say native. I don't want to say Native Americans because then you're thinking you're going to be American Indians. Naturalized Americans, whether you're born here or you have gone through the citizenship, and that's important as well. So where the job issues may keep coming up, I think the weakness will come from government. There may be some weakness from healthcare due to the overemployment that's taken place there, but I eventually think the economy will improve enough to expand out certain areas. And the AI factor, I don't know.
Yeah,
I don't like to think about it.
Yeah, just put your head in the sand.
But for now, I mean, we're not having, weekly.
I've got AI Brad coming in for stock picking next year.
Yeah, we don't have weekly jobless claim numbers that are out of control. And we had one of our lowest numbers in a while 2 weeks ago. So, whereas there's not been a lot of growth, there also hasn't been a ton of loss either.
Yeah.
So
it's kind of Goldilocks. We would say that economy,
not
too hot, not too cold, or
who knows?
Yeah. But those are things we'll be watching as we go into 2026. And you wrote some of your thoughts here of some of the things that you're going to be looking at. First is, we always talk about presidential election or cycles. So we'll be in the second year, which is typically, as you usually say, not the best year out of all the 4 years. Typically is the one that struggles the most, but could be different this year.
Well, I got data back to 28, but on the S&P, but I'm not going to go back that far because, we're a different place than we are now, say 1950. So if I just go back to 1970 and I look at the midterm election years, the performance of the S&P, I mean, it's around 3% on average gain, which is, part dividend, part performance. That's a big difference from what we see in the other 3 years of the presidential cycle. So for some reason, it's always the weakest. I don't know why, but it just works out that way. I'm sure a lot of it has to do with the politicking of the midterm elections. But the benefit of the volatility we expect to see is that it leads into next year, which is always the most promising year of the cycle.
The third year.
Yeah, the pre-election year is always by far. It's always been positive since I think 1938.
I always thought you said the first year, but it's
the third year is always the best.
First year is honeymoon. Second year, people push back, and then the third year.
Pre-election year is great. Election year is usually pretty good too.
Okay.
But if you go back 2018, the market was down about 5%. And the market really went through two negative cycles. It went through Trump's tariffs early on in the year, and then it went through just the bloodbath that was October, November, December, which had to do with the Fed being too tight, dealing with quantitative tightening for the first time at the highest level. So the market didn't end up very well, although, through September, it looked like we were going to be pretty good. In 2022, we know it's just a mess, down almost 20%, dealing with historic rate increases, the 75 basis point rate increases, which you never saw, going from quantitative easing, flipping right to quantitative tightening. So if I look at those 2 years and both of them, the last two midterm years, both being negative, the one promising side of this year is that the Fed is going to be on our side. The Fed's not going to be fighting against us. They're not going to be raising rates. They're not going to be in a quantitative tightening period where they're adding more and more bonds to the market. They're going to be in a stimulus phase.
With the Fed put, is that back?
I wouldn't say that yet, but
they're
we're not in a interest rate rising environment. That's the main thing. So that should be a pretty big positive this year. But if we're going to follow what normally happens, we see some weakness into February. We see the market rise into April. And then from April basically to the end of September, you see weakness. And then as we get closer to the midterm elections and then through the rest of the year, we usually have a pretty solid rally. If you remember 2022, we almost bottomed at the end of September that year, because the last 2 weeks of September were absolutely brutal. We rallied in October and November and then fell apart a little bit in December, but the worst was in September of that year. So, whereas in 18, the worst was Christmas Eve. So we expect there to be more volatility. We expect there to be some more issues as far as, the shifting inside of the market. But we're hopeful that because we're not fighting the Fed like we've had to do the last 2 years, in the last two midterm years, that volatility isn't as much, and it could end up being a pretty significant tailwind for the market.
Maybe some of the laggers like value stocks or small caps maybe finally start catching.
They should, because if rates are coming down, then
it's good for them. Yeah.
It should make them more attractive.
Mm-hmm.
And we do. My second point is we do expect a much more dovish Fed. Right now, we're looking at 2 rate cuts. I expect there to be talk for more. We do have a new Fed chair coming in, I think in May, which obviously will be dovish from where Powell is, because I think there's some good things at the end of the day that Powell brings, but I think he's excessively confused and at times compromised, based on where he was a decade ago to where he was 3 years ago, 4 years ago to where he is now. So, more dovish Fed is a major tailwind. Rate cuts, new Fed chair, and on top of that, we've started up, quantitative easing light, where they're buying a certain amount of bonds each month to help lower that front end, the shorter term borrowing costs. That's supposed to, at least work through the first quarter, maybe into April. I expect if things get weaker that they will just do a full blown QE at that time and say, okay, we're just going to do a flat out $40 billion a month and buy different.
They have a lot of bonds coming due this year, right?
Well, my third point, which we've kind of seen already, is that although the Fed has been cutting rates, bond yields remain sticky. Mm-hmm. So Treasury yields remain sticky. So if you look at the 10-year, we've cut a 1.75 since September of 2024. Yet the 10-year yield is higher than where it was in 2024. So we've brought the Fed rate down from 5.5 to 3.75. Yet yields have remained relatively sticky, and a lot of that has to do. There's still some inflation fear out there, which shouldn't be as big of an issue. The real issue is the amount of bonds that have to be refinance this year. So I think we're looking at like $9 trillion of treasuries, which is basically a quarter of the treasuries that are out there floating throughout the world, have to be refinanced. So that kind of puts a floor underneath, because the market knows there's going to be a lot of supply coming. So that kind of has put a floor underneath yields. As we get through this year, I think yields will eventually start to fall back in line with where they should be relative to where interest rates are. And that also has to do, again, with quantitative easing and helping to bring down that short end of the curve, so it can help with refinancing shorter term bonds. Because if you go back to, let's say we have 2-year bonds that we're going to refinance next month. They're probably coming back to us at a 5% yield, somewhere around there. So we're getting a discount refinancing those right away, because they're not going to be, resold at such high level of yield. But we still need to get that shorter and lower in yield, because that's our shorter term paper that keeps rolling over more and more and more. And that's where most of the treasury issuance is.
Gotcha.
But I expect yields to remain sticky, stubbornly sticky.
Same with like mortgage rates too. Do you think that?
Yeah. Mortgage rates should be, they're based off a couple of different things. The SOFI rate has gone down, SOFR has gone down, but they're going to base that off 30 years, 10 years, as well as some other indicators. So, yeah, it's going to be sticky for a while.
Yeah. So I don't think people, unless the economy really rolls over, right? Then you got people selling stocks, buying bonds, and the demand goes up. Then that would, to me, be the only way you'll see interest rates really drop and bond prices go up. Which is, not a bad case to have a little bit of as a hedge against your stock portfolio. The way I would approach it is if the economy starts to dip, if the unemployment situation gets worse and we headed to a recession. I mean, I don't really hear anybody except for a few firms that always call recessions that we know, a possibility of a recession if the jobs numbers continue to
Well,
worsen.
if you go from the traditional standpoint, which I guess was thrown out the window in 2022, it's not in the future right now. I mean, because you have to have 2 negative quarters of GDP growth, which we had in 2022, but they changed the rules to say we didn't because of the unemployment side of it, which doesn't make sense. So with where the GDP numbers have been coming in and what they're expected, we would have to see a relatively large shock to the economy to get to that point where we could see 2 negative quarters of GDP growth. So traditionally, it doesn't look like there's one in the future right now.
Yeah.
But I mean, that could change.
Well, that's what I'm saying. I don't hear anybody talking about it. To me, that puts up a red flag.
And there's
maybe we should be.
My other point is there's a wall of worry out there, and the market always has to climb the wall of worry. And we've gone through a lot the last since COVID. I mean, we've gone through COVID, massive increases in interest rates, inflation that we haven't seen in decades, the tariff scare. A number of different things that the market just keeps getting past. Now, 2022, when we have a Fed that we fight with, it can be a little more difficult. But again, we're not in that situation. But there still are things out there, like we talked about AI and what its valuation is, and is it going to keep going? People are going to continue to worry about that. We're going to get earnings in the next 4 weeks or so out of the big AI tech companies again. And if they say they're going to spend more money than what they did last quarter, everybody's going to come out screaming. So that's something we got to get through. Is the market expensive? I keep saying, but there are the experts out there that will say, when the market's trading at this high of a PE, you always got to sell. That may be the case, but it doesn't really matter till it matters. And we're expecting earnings to remain good. We're expecting 14% EPS growth this year in the average S&P 500 stock. So where historically it might be expensive, it's not terribly expensive. So
especially if the other stocks, the other 493, haven't been, participating as much and haven't gone parabolic, that they've been consolidating, they've been, tightening their budgets, and who knows? I mean, I think this could be the year where everything else is what helps keep the market from really tanking, if it's going to tank. But and then you got people also spending, right? We talk about spending. This is going to be a year. I don't hear anybody talking about this, about the anticipated tax refunds because of some of the tax law changes.
Well, we're kind of forecasting that we'll see a 40 to 50% increase in the amount of tax refunds because of
that's huge.
Big beautiful bill. Last year, tax refunds were roughly $270 billion. So we could see an additional 110 to say 135 billion in tax refunds. That's a big stimulus for the economy. That's a big benefit for consumers. We get to that point, it's going to be a bonanza that we haven't seen probably since, the excessive savings rate caused by COVID. Not going to be on that scale, but it's going to help out a lot of consumers, and that money will find its way back through the economy. And that should be relatively consistent because these tax law changes are going to stay in place at least for the next number of years. So
I think we need to bring on one of our CPAs to talk about what can people expect, whether you own a small business or even just you're retired and you're receiving Social Security, you're going to get likely get a bigger refund. So.
Then it's a massive benefit for the average citizen, especially for keep talking about lower middle class getting squeezed. This is going to be a big benefit. One of the walls of worry that we have too is a potential another government shutdown, because we still haven't come to an agreement yet on the healthcare tax subsidies. And I think we have until the end of January before we shut down again. So I don't know if it's going to be a political ploy by the Democrats to use that, to harm Republicans in the midterm election. But we've got to start to come together and figure this stuff out, because the benefits that we're trying to get through the economy, and it goes both ways, depending on who the administration is, these benefits that we're trying to push through aren't going to be useful if we don't have a government that's working correctly. We got to get past this infighting between both sides.
You're calling for unity.
Yeah, well, one negative that, it'd be a short-term negative. Some people think it'd be a positive, but one negative that could pop up early in the year would be, my estimate is the Supreme Court's going to rule against Trump on his tariffs that were installed using the International Emergency Economic Powers Act of 1977, or the IEEPA. I'd rather have them not do that, because I think the benefits we're getting from tariffs are going to be a longer term benefit. But as I was taking notes today, you really should go through Congress to set up the tariffs. As once they rule, Trump will have to go through and use the Trade Act of 1974 rulings to then work with Congress to reestablish the certain tariffs that would be upheld by the Supreme Court. But a ruling like this basically helps cement the fact that Congress needs to be involved in tariff decisions, and we just don't want to have too much power given to the president to be able to use an Emergency Powers Act for certain things that it shouldn't be. And whether it should be or not for tariffs, you can go both ways on it, but my gut feeling is they're going to shoot it down. And there might be some disruption. I don't think they're going to force refunds on what's been claimed as revenue so far. There might be a little disruption short term because of this. But again, with the Republicans having control of the House and the Senate, they should be able to push through the proper legislation to get approved on just these tariffs. There's still a ton of tariffs that have been put in place that are going to remain in place. And secondary deals have been done that take away a lot of the tariffs that were announced during Emancipation Day. But
when are they supposed to rule on that?
I assume it's sometime later in January.
Okay. So it could bring a little spout of volatility there.
It could. Most people view it as a positive.
More protests out of
no
Kings blocking the roads again.
Well, people, the No Kings people will think it's a positive because companies aren't going to have to worry about tariffs, which isn't going to be the case, because the tariffs are going to be reestablished, and they think you're going to have to refund the money, which I don't think I think the Supreme Court will make it active as of that day. So what has come previously isn't going to have to be refunded.
Okay.
So.
All right.
And one final thing, you told me not to get into this, and we talked about the dollar. We still expect the dollar to remain weak. As we talk about funding for the government, funding through treasuries, the amount of debt we've got to roll over this year, refinance this year, quantitative easing, quantitative tightening, what the Fed's going to do. There have been some rules that were put in place after the financial crisis that helped control the banks and bring things back in line. But we're starting to learn that some of these rules are probably a bit more constrictive than they need to be. One's called the supplementary leverage ratio, SLR, and it basically helps the banks and their balance sheets to stay in order so they don't get extremely over leveraged, like the banks at like 40-1 back in the days of the great financial crisis. The issue is that this rule treats the risk of treasury bonds as the same as the risk of a junk bond. And I assume that at some point this year, they're going to rewrite the rule that allows the banks to, I don't know if it's going to be buy as much as they want, but I think they're going to allow the banks to increase the amount of treasuries they own without having to use capital to keep the leverage ratio in line, because they're basically risk-free investments. We did this during COVID to help even out the treasury market. It didn't cause any problems. It would greatly help in keeping yields under control with all the refinancing going on this year. Banks would love to own a lot of these bonds, and it would greatly help the overall liquidity of the.
So you're hoping that occurs? Is that?
Yeah, because it takes the stress off of us too, as long as it's under control. You know, you just don't let a bank go 75-1 leverage, but you allow the banks to take on more of these risk-free assets, and that would help with us not having to do so much quantitative easing in the future too. It'd save us as taxpayers. So a lot of these rules after the financial crisis were great, but they're just we're finding some of them are a little constrictive. In helping liquidity in the bond market, treasury market, trickles down. It would help the liquidity in the overall market. It would help with mortgage rates, everything. Bottom up, middle out.
All right.
So, it's hard to say what's going to happen this year. I would just say expect a lot of volatility. I would, unless something changes, I don't think we're going to see the size of gains we have the last couple years. I don't think the risk of a midterm year is as big as we see in the past because we're not fighting the Fed.
So there's a lot on each side. I mean, that's why but anything can happen. And I think that's one of the lessons we learn is people can make all the predictions they want to, but
we're in a different place. I mean,
yeah.
Look where we were in 2021 at this time. We were dealing with 7-8% inflation. We're dealing with a Fed. We're dealing with a Fed that has started talking about raising rates and ending quantitative easing. They were turning off the spigots, whereas now we're the other way around, turning on the spigots.
New high in your breath.
Yeah, breath remains good.
Measures the healthiness of the markets. How would you explain that to our listeners? The breath.
There's more stocks and investments going up more each day than going down.
Okay,
that's basically it. So the more going up, healthier things are. The more going down, the weaker things are. And we need to see divergence, whether it's in the New York Stock Exchange or high yield bonds. We need to see divergence in breadth with price before we get concerned. And right now, everything looks good.
All right.
And I assume January, I want to say, is going to be good. It's just hard in a...
Even with the Supreme Court coming out?
It's just hard with a midterm year, and also with the amount of gains that people are sitting on. You don't know what we're going to see the first few days of the year when the clock rolls over, the calendar rolls over, and people say, okay, now it's 2026. I'm going to go ahead and start to sell some things so I don't have to pay taxes for another 15 months.
I think we've said that too. So
but then I realize that most of the time when we sell things, we probably should have held on to them.
Right. Let your winners ride. That's what they say. But
exactly.
Hey, excellent year, Brad. You did a good job.
Thanks, Greg.
Your calls, I'll give you some kudos there. Your calls.
Glad you set this wonderful podcasting room up.
Yes, I want people to hear, what you have to say because you're quite good. So.
Well, I'm just hopeful that people check in next month to see what my outfit is for February.
Yes, I know I will be looking forward.
Wait till March or April. I don't know when Easter is, but holy crap, am I going to dress up in a bunny costume?
Oh man, we will all be excited for that. So,
I am.
I know. Well, that's it for the View from the Ranch January edition. And
Happy New Year, everybody.
Happy New Year. We appreciate you. Thanks for watching. And if you're on YouTube, click the subscribe button. We would love that. See?
Like.
Yes. We get up to maybe 50 followers now. So we're on our way. So this will be our year.
How many fake accounts does your mom have?
Yeah. Hi, Mom. I know she's watching. So that's good. She's our #1 fan. So, all right. Well, you guys take care. God bless.